Hello and welcome to Business Standards Morning Show. I am Rishika Chakravanshi and let us take a look at the stories for today. Has Asia's richest man taken some cue from the Waltons, the US's wealthiest family? Reports of Mukesh Ambani charting a succession plan by setting up management trust surfaced recently. Chennai-based Shriram Group has also followed the same route. Let us examine how India's super-rich plan to pass on the reins and their wealth to the next generation. Is it being done to avoid the succession battle, or these families are taking the trust route to ring-fence their wealth?
Some of India's biggest business conglomerates were started by families such as the Tatas, Birlas, and Ambanis. And most of them have gone from strength to strength thanks to the advantages traditionally enjoyed by the family run businesses, such as greater stability. But they are also susceptible to succession warfare, which can rip apart a wealthy clan. For example, consider how things played out between Mukesh Ambani and Anil Ambani. This is where the importance of succession planning comes in. Apart from the feud between the Ambani brothers, the Bajaj family dispute and the Chettinad family dispute are some of the examples of how family businesses can end up spending considerable time and resources on such squabbles. But do family-owned trusts actually stop succession disputes from occurring in the first place? And just as importantly, do they lead to a clear management structure? Another important factor to be considered is the tax implications. However, are smooth succession and avoiding feuds the only motives behind adopting this model of governance? Could the other reasons be that some fear the reintroduction of an inheritance tax or wish to ring-fence their assets to navigate around bankruptcy laws? To get a clear understanding of the trust route, we spoke to Mukesh Bhutani, managing partner at BMR Legal.
Traditionally, wills were used as a tool for drawing out these forms of planning. And the will route also has resulted in many disputes insofar as the execution of the will is concerned. Whereas in a trust structure, the settlor lays down very clearly as to who are the beneficiaries. Either the beneficiaries' shares are defined, which is called a specific trust, or they are undefined, which is called a discretionary trust. One of the important objectives is certainly avoiding family disputes and having a very clear, division of role and responsibility. But we should bear in mind, it's a complex exercise in India. The complexity is driven largely by the fact that the families are large. There are multiple factions involved in the business. Deliberations have to happen and succession issues have to be laid down after a debate. All of these are reduced into a document called the trust deed document, and hence how you draft that document assumes significance. There is a specific exemption that has been granted under the Indian income tax law, which says that a transfer of a property, which is the action of the settlor into a trust, is not a taxable transaction. One of the reasons trust is also used as a tax efficient structure, and people are putting that in place, is because if India legislate an inheritance tax, then the trust structure protects you from the levy of such futuristic inheritance tax on the property that is getting transitioned after the death of the owner of the asset.
According to the PwC Family Business Survey 2021, just 1 in every 5 Indian family business has a robust, documented and communicated succession plan in place. The direction taken by the Ambanis and Shriram Group will inspire others in the country.
Just like the family-run conglomerates, private equities in India have also witnessed a good growth. The velocity and volume of capital saw a dramatic rise in the private equity space in 2021, says Renuka Ramnath founder and CEO, Multiples Asset Management. In an interview with Business Standards, Shurajit Dasgupta, she shares the big numbers of the Indian private equity industry and why it has been an exceptional year from investment, exit, and investment valuation perspective. Let us hear it all from Ramnath.
2021 sort of ending. How has been this year for the private equity space and for multiples, considering obviously there is still uncertainty about the pandemic and the future?
Yeah. So, Surijit, I think 2021 has been an exceptionally good year for the industry and equally an exceptionally good year for multiples. In fact, multiples is a little over a decade old, and internally we say that 2021 was the best year for us in 10 years. In 2021 alone, we have seen close to $60 billion of capital flows, which is the highest in any year, I would say. So that has helped a lot. That has bolstered the confidence. It has allowed for several companies to raise further rounds of capital, give exits to incumbent investors. We have done more than 120 deals as an industry, over $100 million in 2021, and over 20 deals which are more than $500 million ticket size. These are like staggering numbers for Indian private equity industry. So the velocity of capital and the volume of capital has been pretty dramatic. For multiples, we had a record year. We have returned our second fund. We have had some blockbuster exits, and our the NAVs of our funds are something what I had promised will be the NAV in 23 or 24. We realized in 21. So it's been an exceptional year from investment perspective, from exit perspective, from follow-on fundraising in our portfolio companies, valuing our own investments at a higher level.
So do you see that there is a lot of this euphoria where private equity funds are putting in money in the hope, that they might exit even before IPO or after IPO and make money because of the overall euphoria in the system?
Capital is available for disruption. If you have a powerful idea, or even a less than a powerful idea, somebody is willing to give you risk capital. So the opportunity for entrepreneurship has become manifold. The opportunity for disrupting literally every business has become manifold. Services part of the economy is just busting all charts in terms of growth. And therefore, I won't call it euphoria. I will call it a real opportunity on the ground to build new businesses of scale. Currently, there is a huge desire for many capital market players, including individual investors, to have these new age companies in their portfolio, lest they will miss out a piece of disruptive action. Time will tell whether these companies have got over discounted for their future potential. There is a strong change in the ground, and there is a strong disruptive trend, and there is a very, very real possibility of creating humongous value from this disruption.
What are the regulatory changes do you basically as an industry look for from the government?
Yeah, not just the government, but SEBI as well.
SEBI, yeah, everybody.
Instance,
all the
one of the most nuanced thing about our business is that we are a pooled vehicle, right? And investors come from various categories into the same pool on a common document. However, everybody wants co-investment rights, and to our portfolio company, we want to be seen seamless between our fund along with our co-investors. So, regulations which will allow you to bring in co investors uh, and give them units of specific assets, uh, and all the flexibility in the fund documents to make this happen will go a long way in building the domestic fund manager market. For people like multiples, because internationally all this flexibility is already there. Second, leverage is prohibited in India, so we are also disadvantaged vis-a-vis international taxation. Regulations have to be crystal clear in terms of what's the tax impact to the managers, tax impact to the investors, tax impact to the co-investors, and so on. While progressively very good positive changes have happened, I would still say that we are on a journey and we are not close to the destination, especially when it comes to tax impact on the managers. It is in a very wide range and open to a lot of interpretation risk, which makes our business for ourselves very, very risky. Lastly, we have been making a plea that there should be no GST on the fees that we collect from our international investors, because it's export of services. Again, because if you pull it in an AIF, you cannot escape from it under the present set of laws.
Renuka Ramnath sure has some staggering numbers to flaunt about the Indian private equity industry. Turning to the market, we have seen it logging gains in the last two Decembers, and we're up on 6 out of 10 occasions since 2011. Will the markets make a hat trick of rallies, or will the Omicron threat prevail this December? Watch our next report to know what markets experts expect.
The frontline Sensex has bounced back nearly 1,400 points in 2 days, staging recovery from one of the worst bear drubbings in months. On Thursday, the index ended at 58,461 levels, up 776 points on the BSE, lifted by healthy buying in HDFC Twins, RIL and IT stocks. The NSE Nifty, on the other hand, is back above the 17,400 mark. Meanwhile, in the primary market, ace investor Rakesh Jhunjhunwala backed Star Health and Allied Insurance initial public offer closed with 79% subscription. According to AK Prabhakar, who is head of research at IDBI Capital, Star Health failed to attract investor interest as the valuation seemed rich and left nothing much on the table for investors. The IPO came at a time when fears of the Omicron COVID variant started. This, he says, may have made investors wary of investing in an insurance-related play. That said, the IPOs of Anand Rathi Wealth and Tega Industries received healthy investor response and have already been fully subscribed. So, will this recovery in the secondary market gain momentum going ahead? Let's find out. Despite a 3.8% fall in November, the BSE Sensex stands tall with a 19.5% gain at the start of December 2021. Over the past 11 months, many market participants have negotiated many headwinds successfully, such as rampant spread of a second COVID wave, boiling crude oil prices, inflationary pressures, and fears of policy tightening and withdrawal of government stimulus. Nonetheless, markets did witness minor corrections as and when these headwinds emerged along the way. Data compiled by Vinod Karki of ICICI Securities shows that in the past 18 months, the markets paused for correction 5 times, with the latest one starting in October 2021. However, the recovery on the bourses was swift every time, with benchmarks hitting fresh highs. So, should we expect resumption of uptrend this December? Historically, the Sensex has delivered a positive return in 5 out of 10 occasions in the past 10 years, that is, since 2011. These returns ranged between 0.4% and 8.2%, data shows. While developments on the Omicron variant would be key for this month's market trajectory, analysts at Credit Suisse say factors like corporate earnings, interest rate decisions by the US Fed and RBI, and the rupee's trajectory could determine the market trend going forward. The brokerage further observes that earnings will be the key driver of equity returns in 2022, and investors should expect high single-digit equity returns next calendar year compared to double-digit returns in 2021. For Vinod Karki of ICICI Securities, the current phase of correction is another such pause or consolidation before the next surge begins. On Friday, global cues, FII activity, outcome of OPEC Plus meeting, services PMI data, and initial public offers of Tega Industries and Anand Rathi Wealth will guide investor sentiment.
Just like the markets, the mood is also upbeat in the auto sector, which is bracing for a big change in the days to come. Amid the tightening CO2 emission norms, car makers across the world are racing to develop electric vehicles. They are also investing heavily to reduce the cost of solid-state batteries on which these low-emission and almost silent vehicles will run. Let us find out more about these powerful, rechargeable batteries and will they be able to replace the gasoline-run vehicles in the long run.
Experts across the world believe that electric vehicles will sooner or later become mainstream. They find it a more sustainable form of transport. But on what kind of batteries will these future electric vehicles run? Car makers are preferring the solid-state batteries over the older lithium-ion batteries. Let us find out the difference between them. For years now, electric vehicles have been powered by lithium-ion batteries. These batteries are similar to the ones used in our mobile phones, laptops, and other consumer electronics. They use a liquid electrolyte which makes them not only heavy but also vulnerable to instability at high temperatures. A lithium-ion battery uses liquid electrolyte solution which makes it flammable and raises safety concerns, while a solid-state battery uses solid electrolyte. It has more energy density and is safer due to a lack of flammable liquid in it. Solid-state batteries could prove to be a game changer for EVs and accelerate the shift away from fossil fuel-powered personal vehicles. Solid-state batteries are not a new technology. They have been in use for years in small devices such as smartwatches and pacemakers. It is their use in a heavy-duty application like automobiles that is the new element here. But the road leading to green mobility seems to be bumpy. So far, companies have built solid-state Li-ion batteries only inside labs and one at a time. They are far from being manufactured at a large scale. Currently, a solid-state cell costs about 8 times more to make than a liquid lithium-ion battery. Car makers will also have to bring the mileage of electric vehicles on par with gasoline-run vehicles. For that, the companies and government will have to invest heavily in research and development of better solid-state batteries. But the good news is that more and more companies are rushing to get a slice of the electric pie. Companies like Tesla, Ford, Ola, and BMW have invested heavily to bring its costs down and make it more feasible.
That's all we have for you today. We will be back with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.